Hi and welcome to Fiscal Policy Part 2. Okay, and we'll look at the other areas of the definition of fiscal policy. So we've looked at borrowing, we're now going to look at taxation and spending. Okay, firstly we've got to look at the aims of taxation. So here we have to fund government spending. You can't borrow all of the money for government spending, you do have to get some tax receipts in. You've got to manage the economy as a whole, so you've got to look at manipulating aggregate demand, aggregate supply and long-run aggregate supply in order to meet your macroeconomic objectives, so manage those objectives. Correcting market failure is that micro aspect, so again you're looking at taxation like excise duties on cigarettes and alcohol to manipulate the pattern of demand, to manipulate people's demand for, say, things like demerit goods. Okay, and the redistribution of income and wealth, so perhaps taxing the better off slightly more and those less well off slightly less to balance things out a bit. Okay, so the overall aims there. We're going to look at two areas of taxation. Firstly, we're going to look at direct taxation. So that's a tax directly on an individual or a business. Okay, it comes directly from the individual to the government in tax receipts. So here we have corporation tax, which would be on a business's profits. We have income tax, which will be on an individual's income, so it's directly on those incomes and profits. But let's look at the effect of that. The effect is going to be on aggregate demand here, okay? So if you have higher corporation tax, naturally investment will go down, that's a component of AD, causing a drop in aggregate demand. Higher income tax, that is going to affect consumption, that's a component of AD, and a reduction there. It's also taxation, if there's any injections into the economy, it's going to slow and reduce the impact of any multipliers because you're going to have a reduced multiplier effect from that. You've got to remember though that taxation overall, if nothing else changes, i.e. this is the only change going on, ceteris paribus, then it's going to be a net withdrawal from the economy. So it's a withdrawal, so it's going to lower aggregate demand and have the usual effects on our macro objectives that you'll need to analyse and evaluate. But it's also worth recognising that it's going to could impact the productive potential of the economy, i.e. the PPF or the long-run AS. Because if you increase corporation tax, so I'm only talking about corporation tax here in terms of this effect here, because we're just focusing on this tax, not income tax, that won't have this effect. Okay, if you tax profits, there's less of an incentive to invest in capital, and there is also less profit left over after tax to then reinvest in capital. So that could reduce investment, which will then possibly reduce the productive capacity of the economy. Okay. Now that's unlikely. It's more likely it will just slow the growth of long-run AS, slow the growth of the productive capacity of the economy. Because it's unlikely that investment will drop off so far that we don't replace capital machinery. It's more the fact that we won't grow as quickly in terms of productive potential. So that's that in terms of increasing those direct taxes. Naturally, if you reduce those taxes, you reduce those withdrawals, you'll have the opposite effect of these diagrams. So the other one we're going to look at is indirect tax. So this is a tax levied on goods and services through the firm. So it actually adds to the firm's cost of production. Okay? And therefore, it's indirect because that then passed on to consumers in higher prices. So that tax does not come directly from the individual, but through the firm as an indirect tax, sometimes called a tax on spending. So we've got two examples here, VAT and excise duties. Now, excise duties will only affect individual markets. That's micro, really, if you're going to put, say, a tax on alcohol. Okay? But if it's a significant enough market, like, the housing market or oil, then it will have a macro effect indirectly through that significant micro market, because that micro market is so significant, impact the whole economy. But let's look at VAT, because VAT is on most things, okay? So therefore, it will have a macro impact when you say increased VAT. If you increased VAT, that's naturally going to increase cost of production and push short-run AS back across the whole economy, okay, leading to the usual effects, okay, on economic growth and inflation, okay, and you can see that little contraction along the AD curve there. So there's your effects in terms of those taxes. And remember though, there's lots of individual taxes we could list under both of these areas, and also we'll see in class about progressive, regressive, proportional taxation, and that's important in terms of its effects. Okay, so moving on to the spending part of this. Again, considering ceteris paribus throughout this video, okay? Let's look at the aims. Again, similar to taxation, correcting market failures, let's subsidise merit goods, for example, okay? Or look to create, look to make up for where private firms wouldn't provide goods and services, i.e. missing markets, okay, public goods. So achieve supply-side improvements to the economy. We're looking at subsidising failing industries like the banking industry, Northern Rock, or steel production in Port Talbot. The redistribution of income and wealth, so spending a little more in poorer areas rather than richer areas. And we also have managing the economy as a whole again. So managing those diagrams to better achieve macro objectives and improve the overall performance of the economy. So let's look more specifically. So first we'll look at current expenditure. So current expenditure is effectively expenditure on the running costs of the economy, the day-to-day costs. And that will include things like wages, pensions, benefits, raw materials, my pay, debt interest repayments, okay, and that's continuous, and that's most of the budget, okay, is on this area. But when you look at a pie chart of the budget, obviously it'd be broken up into NHS, police, all those areas, but you could also break it up into current and capital expenditure, and it would be broken up mostly into current expenditure there. So what's the impact of that? Well, it's a running cost. If I increase in current expenditure, that boosts aggregate demand, injection, multiplier effect, just to a certain extent, depends on the confidence or taxation, the extent of the multiplier effect, may well have that effect, and the usual effects on your macro objectives there, okay? So the usual effects you can relate to all your macro objectives. So that's a boost to aggregate demand as an injection. Naturally, reduced government expenditure, going to go the other way. Okay, so capital expenditure is your one-off expenditure on fixed assets, okay? So this is a much smaller part of the budget. Bridges, big infrastructure projects, HS2, hospitals, buildings, capital equipment, okay? So with these, again, AD boost, possible multiplier, because at the end of the day, it's a component of AD, G, it's increasing, normal effects on your macro objectives, multiplier effects potentially, well definitely multiplier, but to what extent, okay? But also, this is where fiscal overlaps with supply side, because it can have supply side benefits, you know, building HS2 will help boost the supply side potential of the economy. So therefore, you're looking at pushing out your PPF or your long run AS, and that helps the productive capacity of the economy with all the usual effects we could analyse and evaluate on our managing our economy, our overall economic performance. It's worth though bearing in mind with all of this, ceteris paribus, okay, because these injections that I'm talking about increasing, I'm talking about no other variables changing. I'm also saying that I'm going to increase them, I could decrease this expenditure. And also, what's the impact also on other macro objectives, depending on where we're in the economic cycle? Are we a negative output gap or positive output gap? So think about that, okay? That's the end of part 2.